Now that global physical exchanges have become sufficiently liquid to benchmark a real supply gold bullion price outside the CME LBMA ring fence, the stealthy gold revaluation process that commenced directly after the Bank of International Settlements revalued gold as a first-tier high-quality liquid asset on the 1st of January 2023 has gathered sufficient momentum to force the US Treasury gold to be revalued. There it is. You can start to see it. And as we've been drawing attention to, every single non-dollar denominated fiat gold price has led dollar denominated gold into all-time highs. So every other gold price in every other currency has been making new highs long before dollar price was dragged higher. But as we've been focusing on, the real game changer is that China took the gloves off the moment that yuan gold became fully Basel III compliant.
Gold has just shattered $4,000 per ounce, and silver is surging toward record highs. But according to whistleblower and market veteran Andrew Maguire, this isn't a normal rally. It's a signal that the entire paper-based gold and silver system is breaking. He says the Fed and major bullion banks are trapped in massive short positions they can no longer hide. If you own gold or silver, this could be the moment that changes everything.
Yet to be repaid US Treasury lease positions. We'll drill into the detail of how vulnerable to a forced gold revaluation this presents the Fed. And we're going to do that shortly, but the far more visible COMEX futures positions. Now, this is the spot market. So let's look at the futures market, which is really apples to apple. Every single month, we evidence how deep a hole the Fed has dug. Now, this is best demonstrated by the sequentially higher end of month and now yesterday's here end of third quarter mark-to-market event. This time, despite a massive effort to rinse out as many spec longs as possible into yesterday's end of quarter, we saw an attempt to rinse out. So basically, to try and mark that down, the bottom line is the Fed was forced to buy back deeply underwater gold leases at exactly $409 per ounce higher than they could last month. Now, given there's still 30 tons to buy back at market, it will drive the offer price to sell gold even higher. So if I'm a seller, I'm going to, and I see this demand coming through, then I'm going to raise that price. It's the Fed that's on the hook for the remaining asymmetrically imbalanced short bets against gold, and having no physical bullion to back up those short bets, and having not anticipated that the COMEX has been forced to become a price taker, the only solution is to once again buy back this borrowed gold at the market price ahead of an impossible to avoid gold price revaluation. And as we just evidenced, currently this will cost them over $400 an ounce, more than last month's BIS repayment. Following a good deal of healthier skepticism around our assertion that the Fed must revalue gold, it seems we're not alone anymore in assessing it for all the same reasons we previously outlined, as picked up for the first time here by Bloomberg on Monday, and also picked up by Zero Hedge alongside other mainstream media publications we're not going to bother to dig into at this point. As we summarized in our last episode, this relentless bricks gold demand has driven the legacy paper market into an impossible to maintain divergent inflection point that can only be resolved by one of two events: a massive bid only T+1 margin call, meaning it's going to be delivered right away. That can only be resolved. So either that way, and that's would spike gold, as we said last time, thousands of dollars higher, or, of course, much more equitably resolved by a more orderly US Treasury gold price revaluation. Now that global physical exchanges have become sufficiently liquid to benchmark a real supply gold bullion price outside the CME LBMA ring fence, the stealthy gold revaluation process that commenced directly after the Bank of International Settlements revalued gold as a first-tier high-quality liquid asset on the 1st of January 2023 has gathered sufficient momentum to force the US Treasury gold to be revalued. There it is. You can start to see it. And as we've been drawing attention to, every single non-dollar denominated fiat gold price has led dollar denominated gold into all-time highs. So every other gold price in every other currency has been making new highs long before dollar price was dragged higher. But as we've been focusing on, the real game changer is that China took the gloves off the moment that yuan gold became fully Basel III compliant, followed by opening up Western-facing institutional-grade gold trading and vaulting facilities, which eliminate unallocated gold counterparty risk. Hey, no-brainer there. And with that in mind, and obviously you need the right liquidity to do that, but with that in mind, with the SGE market holiday coming up, now there is a market holiday, and it starts today. Now, drilling down even further, illustrating the SGE has now overtaken Loco London as the global price setter, the relatively small 3 to 5 tons of Basel III compliant London spot gold that settles at the fixes is actually dwarfed by the 15 to 50 tons of SGE gold physically withdrawn every day. Now, recently, we've evidenced these volumes ramping up fast, hitting record volumes as high as 53 tons, entering warehouses at the end of the day. This gold is flowing into China at the expense of the legacy cartel. Now, these footprints illustrate that the SGE global bullion trading hubs have become sufficiently liquid to discover 2 competing institutional grade Basel III compliant physical fixes. That's Beijing time 10:15 a.m. and 2:15 p.m. That enables the diluted Loco London twice daily fixes to be one-to-one arbitraged as a benchmark. Now, the clues are all there. Each Asia buys physical COMEX sells paper session, and we see multiple examples of it, AM fix versus a PM fix. Now, we have seen some change in behavior, but usually it is Asia buys and the West sells. And again, we've seen, although we see a break in behavior here, it's simply because the shorts got squeezed more than they could cope with. And again, we see a new high being made today, Wednesday, and then the PM fix coming in lower. All that does is set up China for an Asia to set up a bid-only situation, which we saw after the sell-off. Okay, so China's on holiday, but the PBOC certainly is not. And as I say, ETF demand will not stop. It's only just begun. Now, let's look at why CME margins, meaning the cost to borrow 100 ounces of a gold contract from the house, currently is $17,000 per contract. Now, let's look at why they have not raised these margins from a value of 280,000, which is 6.07% of the value of 280,000. And why? And I haven't even marked the latest highs here. I just recorded this yesterday. That was 390,000 per contract value. And the CME margin was still only 17,000, which is only 4.3% of the value. Now that raises the question, why have the CME, essentially, why has the CME not raised gold borrowing margins into the subsequent? Now, bearing in mind that we talked about how speculators buy and you want to knock them back down. You want to untake with impunity, add short positions against them and then raise the margins, and they're so leveraged, they simply have to sell. Beggars the question, what's different now? So the post-Basel III gold first-tier reclassification on the 1st of January 2023 had driven a 970 rally from 1,830 into the 1st of November 2024 at 2,800, prompting the CME to raise GC borrowing margins on that day. And this margin increase, as I say, targeted heavily leveraged longs who'd borrowed gold from the controlling COMEX cartel, triggering a 2-week $260 sell-off. As I say, why has it not raised since? Because you're talking a $1,300 gold price appreciation, which just this week.
Andrew Maguire reveals that the world's physical bullion exchanges, especially in Asia, have now become liquid enough to set real gold prices outside the control of CME and LBMA paper markets. This shift began after the Bank for International Settlements reclassified gold as a Tier 1 high-quality liquid asset on January 1, 2023. Ever since, non-dollar gold prices, from yuan to euro, have been making new all-time highs, forcing the dollar-denominated gold price to follow. China's decision to make yuan gold fully Basel III compliant was the turning point. The Shanghai Gold Exchange, SGE, now clears 15 to 50 tons of gold per day, dwarfing London's 3 to 5 tons. With 2 daily institutional-grade gold fixes at 10:15 a.m. and 2:15 p.m. Beijing time, Asia is now the world's true price setter. Maguire says this represents the end of Western price suppression and the beginning of physical price discovery. At the same time, the Federal Reserve and major bullion banks are stuck in deeply underwater short positions. Data from recent quarter-end mark-to-market events shows the Fed having to repurchase leased gold at increasingly higher prices, nearly $400 more per ounce than just a month earlier. With around 30 tons still to cover, every uptick worsens the damage. Maguire warns there are only 2 ways out, either a chaotic short squeeze driving gold thousands of dollars higher, or an official U.S. Treasury gold revaluation to reset the system in an orderly way. Silver mirrors gold's setup. Reclassified as a critical mineral, silver is being aggressively accumulated by China, Russia, and the United States. Yet CME has refused to raise silver margin requirements, a move Maguire says protects massive naked short bets. With 370 tons of October silver contracts demanding delivery and global inventories at multi-decade lows, short sellers are cornered. The only exit is to buy back at market prices, which can ignite a structural revaluation far beyond previous highs. Maguire's core message: the old paper-driven system is dying. Physical markets are taking over, central banks are scrambling for real metal, and the East is quietly dictating global prices. For investors, that means the coming gold and silver revaluation isn't speculation. It's a mathematical inevitability.
Shane, every time I see you, mate, I see silver in your eyes. I actually see that. So, yes, let's have a look at that. For all the same reasons, silver futures margins have not been raised to protect the very large naked, officially short bets against silver. Now, with COMEX now reduced to becoming this price taker, the only solution to buy this silver back at market is to buy it back at market. But hey, Houston, there's a problem. Isn't that a saying? Houston, there's a problem. Silver has just been classified or reclassified as a critical mineral. Now, into really very, very escalating geopolitical and tariff escalations, it's in very strong Russian and Chinese military demand. Now it's in US demand. I mean, basically, that's why we're noting record prices in every single global foreign exchange currency cross, prompting the US to both accumulate and, the word is, soon to ban exports of US silver. There's only one outcome to tightening supply. The offer to sell silver for immediate delivery is simply going to rise. Let's look at a similar look at the silver futures structure for all the same reasons. They haven't raised margin calls. And you think about it. Take a look at this, which is a protection of very large, naked, official short bets against silver. And with COMEX now reduced to becoming a price taker, the only solution is to buy this silver back at market. As I say, here's the problem. And as we just noticed, silver's just been reclassified as a critical mineral. And with it in accumulation with Russia, China, and the US has just begun, probably likely this export ban is almost certain. As I say, there's only one outcome to tightening supply. The offer to sell silver for immediate delivery simply has to rise. So, at a contract value of 165,000, and this was the same period, 2020, when they raised margins on silver to 16,000. Again, we saw a bit of a smackdown there. That was 9.7% of the 165,000. It's still 16,000, and we've actually moved higher now. So basically, even though it's slightly higher now, there's still 6.7% of contract value, which is a hell of a lot less. Now, shorter term, As silver broke out above the identified short stops at 44,275, if you remember, we circled this. I've now added color to that circle, but this is where the circle is, as is this circle at 53. But essentially, it broke out last Thursday. Then we saw UBS belatedly updating their silver spot price to between 44 and 47 per ounce, stating it would bring it in line with their upgraded 3,900 gold forecast made a couple of weeks ago. They also reaffirmed their intention to stay long and would view all pullbacks as buying opportunities in both gold and silver.
Andrew Maguire believes the Fed's golden trap is now closing, and this could be the most explosive moment in precious metals history. Do you think the U.S. will be forced to revalue its gold reserves, or will they risk a full-scale financial reset? And how high could silver soar once supply vanishes? Share your thoughts below. Do you see this as the dawn of a new monetary era? Don't forget to like, subscribe, and hit the bell for more breaking updates on the unfolding gold and silver revolution.